Gold and silver are real tangible wealth. But in today's world, most investors only own them on paper. In today's episode, we are going to discuss the paper market, how it is traded, and how these paper markets actually distort the true price of gold and silver. Welcome back to The Money Revolution, a podcast where we empower one another to build wealth through the sharing of information and ideas about how money really works. I want to say a very big shout out to our channel sponsor, Stokvel Gold. Stokvel Gold is an authorized dealer in gold and silver that is registered with the Financial Intelligence Center. Stokvel Gold assists us with all of our own gold and silver purchases at the lowest prices that you can get anywhere on the market. Now, if you are interested in commencing your own gold and silver journey, whilst at the same time expanding your investment portfolio, make sure to hit the Stokvel Gold link in the episode description below, and they will take good care of you. I will once again be your host, Masijela Wagamanzo, and I am very excited for today's episode. Now, before we get into the crux of today's discussion, I want us to do a quick recap on a very important principle that we've discussed at length here at The Money Revolution. That in the past, money was in the form of gold and silver. And as trade expanded, people started using paper certificates that represented the actual gold and silver that was in storage in the vaults and also the storehouses. These paper certificates were meant to make trade a little bit more easier and also efficient, because at that point in time, trade was expanding. The issue came when these storehouses and banks started issuing more paper certificates than they had gold and silver in storage. Now, we've reiterated this quite a lot, and on a point of emphasis, that is outright fraud. And it is also the cause of inflation and the collapse of many ancient civilizations, and inevitably the one that we are living in the present moment. I think the big question is, what is paper gold? Now, in today's world, paper gold, and I'll be using paper gold and paper silver interchangeably here, so don't be lost in that sense. So paper gold takes on a different form in today's world. It's not an actual gold or silver coin. However, it is a share in a company that holds physical gold in a vault. Now, this share is in the form of what we refer to as units, and these units are traded on the stock exchange. These companies that store this gold and sell these units to investors are what we call exchange traded funds, or ETFs. Now, when you buy an ETF unit, you don't actually get a piece of gold or silver in your hand. Instead, what you get is a share certificate that tracks the price of that specific commodity, either gold or silver. Now, these units are traded on the stock exchange just like shares of publicly listed companies. Now, let's make this a little bit practical. Let's say an ETF holds R1,000,000 worth of gold. It can decide to issue 1,000 units, each priced at R1,000. Now, if the price of gold or silver was to increase by 50%, which it has done over the past 12 months or so, the total value of those specific units will be priced at 1,500 rands. Now, in that case, investors may decide to go on and sell those units for a profit, just like you would on shares that have shown some form of capital appreciation. The big question is, why do people choose to invest in these ETFs over the actual physical metal? Well, firstly, ETFs are considered to be convenient in that you can buy and sell them through stockbrokers in a matter of minutes. They also give you exposure to the price increase or decrease of gold and silver without having to worry about the physical storage of the metal. The third reason is that you can trade these ETF units very easily without having to worry about the physical delivery of the metal or its storage. I know, Mo Africa, that it sounds very, very, very simple and also a little bit safe. But there is a serious risk that is attached to these ETFs that often investors overlook. So what are these risks that are attached to these ETFs? So the first one is that you do not own the metal. What you own is only a paper claim, and sometimes it's not even a claim on the physical gold itself that is in the vault. It's just a mere share in a fund that holds the gold. And in a crisis, those paper units effectively become meaningless in that you cannot go and exchange them for either gold or silver. The second risk is that almost all ETF units cannot be redeemed for the physical metal itself. What they do is that they only give you the money in return, and that money is essentially the paper money or currency. In fact, you should think about them in the same way that you would of lottery tickets. You are effectively betting on whether or not the price of gold will rise or fall. You can decide to cash in on your unit and make a profit, but you can never go and redeem your units for the physical gold itself. The third risk is that because the ETF unit is priced in currency, when the currency actually collapses, your investment will lose its value along with it. The fourth risk that is attached to these ETF units is that ETF units are not money. Now, what I mean by that is that you cannot go and exchange your ETF units for either a cow or a piece of land. But however, gold is still widely accepted as a means of exchange even to this day. In the culmination of this episode, I want us to discuss by far the biggest risk that is attached to ETF units, and it's something that we refer to as price manipulations. ETF unit prices are heavily influenced by institutions that trade them, and these institutions are known as market makers. These encompass your banks and other large financial players who buy and sell ETF units to keep the price close to the real price of the actual physical metal, which is in the form of either gold or silver. In theory, these market makers should help to ensure that there is fair pricing, but in practice, manipulation often happens. For example, a large bank can decide to sell a huge amount of its ETF units all at once. Now, what that would do is that it would push the price of the ETF units down significantly, and then what they would do is that they would go on and buy back those ETF units at a lower level, betting and also profiting on the price rebound. This is a form of collusion and it is considered illegal. But with ETF units that are related to either gold or silver, it happens often enough to make markets move. Even more concerning, Mo Africa, is that the underlying price of gold and silver is manipulated on the metals exchange. When that happens, it automatically affects ETF prices. And what this means is that the real physical gold market also becomes distorted by the paper trading market. And just as a point of reference, back in 2001, a lawyer who goes by the name of Reginald H. Howe filed a lawsuit against the Bank for International Settlements. Yes, you guessed it. That is the very same bank for international settlements that we dedicated a whole episode on back in episode 14. Included in this lawsuit was also the US Federal Reserve, the US Treasury, and several major banks that included JP Morgan, Citigroup, Goldman Sachs, and the Deutsche Bank. Howe effectively claimed that these institutions were involved in a coordinated effort to suppress the price of gold. He also argued that through various paper gold schemes, central banks and these large financial institutions had effectively created a situation where the paper claim to gold far exceeded the amount of physical gold that was available. For every real ounce of gold in vaults, there are many times more ounces represented by the financial claims. So effectively, this imbalance means that the price of gold reflects also the price of paper exposure to gold and not the true market value of the physical metal itself. The evidence for all this gold leasing, swaps, and derivatives is publicly available in the Bank for International Settlements annual reports, the IMF reserves accounting guidelines, and also some of the filings like your LBMA and COMEX. And we implore each and everyone to go and look at these documentations so that you can see how the modern gold system was effectively built. As a matter of fact, we'll put a link to these reports in the episode description. In conclusion, Mo Africa, I want to make these points. Yes, gold and silver ETFs are convenient, but they do not offer the same protection as owning the real metal itself. If you hold paper gold, you are effectively still part of the paper system. And here at the Money Revolution, we advocate real ownership, where your wealth cannot be erased by market manipulations or even paper fraud. Because truly, when the paper promise fails, it's the physical gold and silver that remain. And of course, that is evidenced by the fact that both metals have been around long enough, way longer than we have been here on Earth, and they will still outlive us as well. We want to show our appreciation, Mo Africa, for you joining us on this exhilarating episode of the Money Revolution. We encourage you to like, share, and subscribe to our channel, and also hit that notification bell so that you never miss out on any of our weekly episode uploads. Mo Africa, let's wake up the masses. Let's understand how money really works, and let's take back our socio-economic power one conversation at a time. And remember, if it's paper, it will perish.